There is one number on your credit card statement that is specifically designed to make the bank money and keep you in debt for as long as possible. It looks helpful, it looks responsible, it feels like you're doing the right thing by paying it. And it is the reason most people with credit card debt never actually get out of it. I got my first credit card with a 1500 limit. I did not max it on one big purchase. It was small things, takeaways, fuel, online shopping, and everyday spending. I tapped the card without thinking because it never felt like I was spending the real money. Within a few months, the balance was at the limit and I had no plan to pay it off. That was the start of a pattern that eventually put me into £30,000 debt. What I'm about to show you is exactly how that pattern works and the 3 rules that finally broke it. Let me explain something that took me years to understand. Credit cards are not just a payment method. They are a psychological tool designed by some of the smartest people in the world to make you spend more than you would with cash. Here's why it works. When you pay with physical cash, something happens in your brain. Scientists call it the pain of paying. You physically hand over something you own and you feel the loss in real time. That feeling naturally slows down your spendings. But when you pay with contactless card, nothing leaves your hand. There is no physical loss and no immediate consequence that your brain can register. Your brain does not process the card spending the same way it processes the cash leaving your wallet. I felt this with my first credit card. I was tapping contactless for everything, food, petrol, or online orders. None of it felt like real spending. It felt like the balance would just sort itself out eventually. I call this feeling the comfort illusion, and it is the foundation that every other credit card trap is built on. Because once spending does not feel real, everything else becomes easier. Easier to spend a little more than you planned. Easier to push the balance to the next month instead of dealing with it right now. Easier to tell yourself you will sort it out later. And later has a way of turning into months and then years. Now the comfort illusion gets you spending. That is step 1. But step 2 is where the real damage happens. Because once you have balance sitting on your card, there is a number on your statement that looks like it is there to help you. It is not there to help you at all. When your credit card statement arrives each month, there is a minimum payment at the bottom. It looks small, it looks manageable, and it looks responsible. Your brain files it as a problem solved for next month. But here is what is actually happening underneath that number. And this is something most people have never seen broken down with real math. Credit cards in UK typically charge between 20 and 30% interest per year. On a £2,000 balance at 20% interest, your minimum payment might be around £50 a month. That sounds perfectly fine on the surface. But out of that £50, roughly 42 is going straight to the bank as interest, and only 8 is actually going to reduce your debt. £8 on a £2,000 balance. At that rate, it takes you over 20 years to clear that £2,000. And you end up paying over £4,000 in interest on the top of original balance. You borrowed £2,000 and you paid back £6,000 in total. That is not a payment plan. That is wealth destruction system. I call this the minimum payment trap. And it is designed this way on purpose. The bank makes the most money from customers who make the minimum payments consistently. They are not hoping you to pay it off quickly. They are profiting from you paying it as slowly as possible. I lived this exact reality on my first credit card. I was making the minimum payments every single month without a fail. I checked the balance regularly and the numbers barely moved. I could not understand why until I saw the actual breakdown. Most of my payment was being collected as interest and almost nothing was touching the balance. Here is a rule that will save you thousands of pounds over your lifetime. The minimum payment is the most expensive way to pay off your credit card. It is not the responsible option. It is the trap. Pay as much above the minimum balance as possible you can every single month. Or better yet, clear the full balance before the interest even kicks in. I'll show you exactly how I do that later in the video. But first, you need to see what happens when comfort illusion and the minimum payment trap run together for months at a time. Because the combination is what took me from one maxed card to £10,000 in personal loans. Let me be honest with you, what happened to me was not one bad decision. It was a slow, invisible escalation that I barely noticed until I was deep inside it. My first card had a 1500 limit. I maxed it on small everyday spendings. I was making the minimum payment every month, so I felt like I had it under control. The balance was not going anywhere, but I was paying every month, so it felt responsible. Then I got approved for a second card with a higher limit. I told myself this one would be different. I would be more careful this time. I was not more careful. The comfort illusion ran exactly the same way on the new card. Within months, I had 2 cards maxed out, both charging interest, both requiring minimum payments. Then the bank did something that felt like good news at the time. They increased my limit on the second card from £2,000 to £5,000. It felt like a reward, like the bank trusted me, like I was doing something right. Here's the truth about credit limit increases. Banks do not increase your limit because they believe in you. They increase it because their data shows you will spend it. And spending it means more interest payments for them. A limit increase is not a reward. It is a bait. I maxed the new 5,000 limit too. I call this pattern the debt spiral. And here's exactly how it works. You max one card on a small spending that does not feel real. You make minimum payments and you think you have it under control. You get a second card for breathing room and max that too. The bank increases your limit because they know you will use it. You spend the new limit, now you are paying the minimum on multiple maxed cards. Then you do what I did. You take out a personal loan to clear credit cards. Mine was around £10,000 to cover a maxed card at 5,000. Another one nearly halfway through 4,800 limit. Now the cards are cleared, but the loan is still sitting there. And this is where the cruelest part of the spiral happens. The cards are empty again, and empty cards feel available. The comfort illusion starts running all over again because the limit is back and the whole cycle starts over from the beginning. I want to be very clear about something. I was not reckless. I was not irresponsible. I never missed a single payment the entire time, and that is the most cruel part of this system. You feel responsible the entire time because you are always paying. You just never realize how little of that payment is actually reducing anything. The bank is happy, your credit card company is happy, you feel like a good customer, and the balance is sitting there, earning them more money month after month. Now, everything I have shown you this far is the immediate damage. But there's a cost to this pattern that most people do not discover until years later. And by the time they find out, it has already cost them tens of thousands of pounds on things that have nothing to do with credit cards. Let me pause here for a second. Look at what you now understand. The comfort illusion is why spending on credit card does not feel real. The minimum payment trap is how bank keeps you paying for decades on the balance that barely moves. And debt spiral is how one card becomes two and then becomes a personal loan and then becomes a cycle that runs all over again. That is already more than most people ever figure out about how credit cards actually work. But remember what I said at the start of this video? There is one number on your statement that is designed to keep you in debt for as long as possible. You have seen it now. It is the minimum payment and you know exactly why it exists and who benefits it. But the damage does not stop when you finally clear the balance. There's a long trail to credit card debt that follows you into the biggest financial decisions of your life. And that is what we need to talk about next. There is one more cost to the credit card debt that most people completely overlook. Your credit score is a number that tells the lenders how risky you are to lend money to. The higher the score, the better interest rate you qualify for on everything you borrow. For example, mortgages, car loans, or even phone contracts. The lower the score, the more expensive every single one of these things become. Maxed out credit cards destroy your credit score. Here is exactly why that happens. One of the biggest factors in your credit score is something called credit utilization. That means how much of your available credit you're currently using. The rule lenders look at is 30%. If your credit limit is 5,000 and you owe 4,800, your utilization is 96%. That is a serious red flag to any lender who looks at your file. It signals that you are financially stretched, even if you are making every minimum payment on time. I call this the long tail because I felt the consequences of this years after original spending. When I applied for the mortgage to buy my first house, all of that credit card history was sitting on my file. The high utilization, the years of minimum payments, all of it. And it made the process harder and more expensive than it needed to be. The decision I made with credit cards in my early 20s was still costing me money at my 30. Let me put real numbers on this so you can see how much it actually matters. The difference between a good credit score and poor credit score on a £250,000 mortgage over 25 years can mean over £40,000 more in total interest. Not because you borrowed more money, just because your credit history gave you the worst rate. £40,000 extra on the same house because of credit card decisions made years earlier. That is the long tail. Now here's the part that most credit card videos completely skip over. I did not cut up on my cards after I learned all of this. I have 4 cards right now and not a single one of them has a balance sitting on it. Because I figured out how to make the system work in my favor instead of against me. Here's the truth that the first half of this video proves. Credit cards are not good or bad, they are a tool. And like any tool, what matters is whether you are using it or it is using you. I call this system the 3 rules. Follow all 3 and a credit card becomes one of the most powerful financial tools you can own. Break any one of them and you are back inside the spiral. Rule number 1. Never spend the money you don't already have. This is the foundation. and it is completely non-negotiable. Before you put anything on a credit card, that exact amount must be already sitting in your bank account. Not coming at the end of the month or not expected from a client, but already sitting in your account right now. If the money is not in your account, the credit card stays in your wallet. This single rule eliminates the comfort of illusion entirely, because you are no longer spending the money you do not have. You are just choosing which payment method the money leads through. The card becomes a routing tool, not a borrowing tool. Rule number 2 is clear the full balance every single month. Not the minimum, not the most of it, but the entire amount. Set up a direct debit for the full statement balance so it happens automatically. When you clear the full balance before the interest date, you are using the bank's money for free for up to 56 days, and the bank earns nothing from you. That is the system working in your favor for the first time. The moment you carry even a small balance past the due date, interest kicks in immediately, and the minimum payment trap is waiting right there to catch you. Pay the full balance every single month without any exceptions. Rule number 3 is treat it like a debit card that builds your credit score. Do not overthink this. Do not try to game the system with complex reward strategies. Just use the card for your normal everyday spending that you would be doing anyway. Groceries, fuel, or whatever you're already buying with your debit card. Put it on your credit card instead, then clear it in full at the end of the month. You spend the same money on the same things you are already buying. But now every month, on time, full balance clearance builds your credit score. Your credit utilization stays low because the balance gets cleared before it builds up. Your payment history gets stronger every single month, and over time, your credit score rises to the point where you qualify the best interest rates available to you when you actually need to borrow the money. For example, when you need to apply for a mortgage, a car loan, or a business loan, you get the best rates instead of the punishing rates that poor credit history forces on you. That is how I use my 4 credit cards now. I rarely carry a balance past the statement date on any of them. If I use a card, I clear it in full every single time, because I spent years on the other side of this, and now I know exactly what it costs. When I finally started using the cards this way, something shifted that I did not expect. My credit score started climbing for the first time instead of being dragged down. The same type of product that destroyed my finances for years was now quietly improving them in the background. Took me long enough to figure out. There is something I'm putting together for the future video that connects directly to this. The exact method I used to clear the debt that credit cards created, step by step using the debt ladder. Make sure to subscribe so you do not miss it. Here is the full picture one final time. The comfort illusion is why credit card spending does not feel real. Tapping a card does not trigger the same loss signal as handing over cash. That is step 1 of the trap. The minimum payment trap is how bank keeps you paying for decades. The minimum payment is not the responsible option. It is the most expensive option available to you. The debt spiral is how 1 card becomes 2, and 2 cards becomes a personal loan that becomes the same cycle starting over. Limit increases are not rewards, they are bait. The long tail is the credit score damage that follows you for years. The difference on a mortgage can be over £40,000 in extra interest from decisions you made years ago. The 3 rules how you flip the system. Never spend money you do not already have. Clear the balance in full every single month. Treat the credit card like a debit card that builds your credit score. And here is one bonus tip most people miss. If you are in the debt spiral right now, with balance on multiple cards, do not get another card to fix it. Write down every single balance and every interest rate in one place. Attack the highest interest rate card first. Every spare pounds goes into that one card. Minimums on everything else until the most expensive one is gone. Then move on to the next one. That is the fastest way out without adding more debt to your pile. Now, once your credit card debt is cleared, the next question is what you actually do with your money each month so you never end up back in the spiral. I made a video breaking down the real UK salary pound by pound with the exact system I use now. That video is right here. Don't click on it just yet. Make sure to hit those like and subscribe buttons. I make videos like this every single week. I'll see you in the next one.